lot to talk about. We do have an instant audit this morning on the markets. We're joined by Ron Davari here in our New York studio. Ron manages money and is the CEO at NewOak Capital in New York. David Buick with the European Perspective, BGC Capital Partners. He's in London. And by telephone, James Sims of Dow Jones Newswires joins us from Tokyo this morning. I think it makes sense to start, David, with you because the concerns, of course, we have our jobs report in the U.S. later today, but the concerns are really centered in Europe, in places like Greece, but also Portugal and Italy, Ireland, Spain. What do you expect next? Will these debt worries stabilize, or do things get a lot worse before they get better?
Good morning, Conal. Good morning, Jenna. Good morning, Ashley. I think basically our major concern is uncertainty. We've spoken about this many times before. Bad news, good news we cope with. Uncertainty, we haven't got a clue. The problem is, how bad is the sovereign debt issue? The Greece thing, okay, we had a first bond issue that went reasonably well, but now we've got concerns about Portugal, possibly Spain, Ireland, and no doubt because all the big countries in the world in terms of finance, particularly the United States and the UK, have been somewhat shy and a little backward in coming forward in telling us about what they're going to do about their budget deficits. This means, of course, that bond yields go up. That means taxation is the order of the day, which means people have less money to spend and less disposable income, which damages retail. So over here in Europe, we're saying, where's the growth? Prove it to us. Non-farm payrolls today. You tell me any time in the last 70 years, despite the market telling me there may be a plus 15,000, January for the United States is an awful month. The weather's atrocious. Construction goes to sleep. And you generally don't find many jobs created in January. In the last 70 years, I can't think of 1 year.
All right, we'll be looking at that number for 8:30 to see if there is any sort of difference this year around, David. You know, Ron, in the Wall Street Journal today, Ian Bremmer, Nouriel Roubini write an editorial about what's going on with sovereign risk. Sure. And what they say is that the market seems suddenly aware of sovereign debt yesterday.
Suddenly.
Is this a delayed reaction to news that we heard about months ago?
We knew that this deficit is going to pile up. Everybody was aware of it. It's all of a sudden the market has woken up and say, why should I be holding these low-yielding assets? And when I know that these guys are going to keep coming back to the market, as a small trader, you know that, all of these countries, it's not the last time they're going to have to come to the well and get some water. They're going to have to keep coming back and coming back.
And that includes us?
Oh, yeah, absolutely. We're just the beginning, right? So when you look at the size of the deficit over the next just 8 years in the U.S. is going to be more than $8 trillion.
Right.
So who's going to finance that? The pension funds are not going to do it because at these low yields, the insurance companies are not going to try to do that as well.
The timing of it is very interesting.
Right.
I was bringing James Sims on that because now that we've brought up the United States, James, Japan and the United States are much more developed markets than certainly than Greece or Portugal or any of these countries that we're talking about. Isn't there a risk that there will be too much focus on fiscal issues and that governments, whether they be here, Japan, and other places, will start raising taxes and stop spending at a time where arguably economists will tell you they need to keep spending because their economies are fragile? What are people telling you over in Asia?
Well, I think right now, Japan, obviously, as we all know, Japan is quite export dependent, and the domestic economy is actually quite sluggish, with the employment issues as well as sluggish wage growth. Mm-hmm. And the government has put in quite a bit of effort in terms of the stimulus packages.
Will they keep it up?
They actually are continuing the stimulus packages, including various tax breaks for energy-efficient appliances, as well as things like fuel-efficient cars, including the Prius, which is at the storm right now.
So, David, going back to you in London, we have a G7 meeting this weekend. Stimulus is going to again be the topic of conversation for us there. A lot of different officials from many different nations talking about continuing that stimulus to help out this economy. So, being that what it is, how do you strategize? How does one position themselves in this market?
Jenny, your television company is about the most charming I've come across, so I don't want to be rude, but I think this meeting in North Canada is an absolute joke. I think it's a complete disgrace that there's been no regulatory controls implemented after 10 months from that jamboree in London, the G20 in April of last year. They're all looking behind their backs. This isn't going to sort itself out. Each country has to show some resolution, get something down on the table, get it organized, cooperate with each other, and get it done. All we've been whinging about is bank bonuses and all kinds of things.
Right.
Regulation's the issue. This is one of the reasons why the banking industry hasn't got its act together. It doesn't know what to expect. It has a good idea, but until you actually implement higher capital requirements, greater transparency, and get the show back on the road, this is why we're in this parlor state we are at the moment, where quantitative easing, we've got to have it because the economy will fall over, but we don't know if it's working because the banks don't know whether the rules have changed or when they're going to change.
Yeah.
David, Connell appreciates the charming comment, by the way. He does. You made his morning. David Buick, appreciate it very much. Always a pleasure. Ron and James as well.
Ron DeVary, just a quick word on jobs before we move on. Market's going to set up for this how? Considering what we saw yesterday, do you think?
I think they're expecting the worst, and if the numbers come in within the reason, it's probably going to disappoint to some extent, but I think the market has already expected a lot worse
so
because of the. It could bounce, yes. Today could be, but going forward, as I mentioned, I think the Treasury market in the U.S. and the government bond market in Eurozone is going to be extremely volatile because there's going to be so much supply, and the central governments central bankers are not going to be able to control the long end of the yield curve, and the long end of the yield curve is where the consumer is going to care because that's where the borrowing rates are going to be. So all of these means that there's probably more pressure on growth.
Right.
That means it's going to dampen it out, which may be overall a good thing after on a long-term basis.
On a long-term, yeah. The difference between short and long-term is really a big part of the discussion. Ron, we're going to talk more about jobs a little bit later on in the hour. Thanks a lot. On 8 million. Wow, instant audit from Ron DeVary, who's our guest from NewOak Capital here in New York. All right, so we're obviously setting ourselves up for something here. What is it this morning? How do you think, or how are you preparing yourself for the number?
The range of the estimate has been -100 to +100.
Yeah.
So, and the market obviously started really trying to digest the estimates, and obviously with the Eurozone being so volatile, I think we have taken a pretty big beating already. So as long as we are somewhere around -25 to +25,000, I think the market is not going to react a whole lot. But outside of that range, I think then the reality of the fact that the rates are going to have to go up, the consumer actually has to slow down.
Right.
Maybe we're expecting too much in terms of growth, and then maybe the equities have to reprice further to reflect that.
What do you think about that question? That seems to be these doubts about whether or not we're really in a recovery, or this has even been just a little bit of a bounce, and it's not really anything you can sink your teeth into.
I think that's really the bottom line. I think the market is slowly trying to figure out the dynamics that's going to go on in the real economy for the next 2-3 years, and that's very much depend on where the rates are, where the consumer is going to be, how the consumer is going to react, and whether we have these kind of expectations. Are our expectations really realistic or not? This is not just a simple correction. I think it's showing that maybe 2009 was more a reaction and a reflex to a pessimism that we had the year before.
Right.
So that now it's about reality. It's no longer about our emotions. It's about how are we going to react to, or how are we going to even cope with the reality in front of us.
There's also a political element to it, though, given the crisis and what we came out of now. I mean, and now, because now, as we talked about earlier, you're in this point where governments are becoming more worried about their fiscal situations as the job situation continues to deteriorate here in the U.S. would lead you to believe you need to spend more to create jobs. But if we start worrying more about deficits, then the unemployment rate continues to go up, doesn't it? I mean, how do you balance those two things out?
That's the uncertainty, that the politicians have to speak from both sides of their mouth. It's not that they haven't been used to do that.
They're experts at that.
They're experts at do that, but ultimately, now we got the election. They can't, if they don't deliver, then it's a big problem. So most likely they're going to err on spending more, trying to get jobs and trying to get and as Obama said, the next 9 months is about job creation, and that's what his agenda is going to be. So spending is not going to be a big issue. Even they're going to talk about it, but at the end of the day,
lip service to the deficit that keeps spending. Okay, fair enough.
So reality bites.
It does.
Reality bites, as always.
Thank you, Ron. That's what she's here for. That's why we have her perspective.
Whenever you get up in the morning, that's reality.
The dose of reality strikes again. Okay, thank you very much, Ron. We don't mean to make light of it, of course.